Good day, everyone. By the way, I am Judela Vergonsado, the first reporter of this chapter, the Chapter 10 Personal Risk Management Insurance. Life is full of risks that you can completely eliminate, and insurance is a way to share this risk with others. And there are two types of risk, the speculative and pure risk. So, speculative risk is a risk that offers a chance or lose or gain, such as developing a killer app that may or may not sell, or investing in a corporate stock that may or may not provide good returns. Such risks can be avoided simply by not participating. They are almost always uninsurable. And when we say pure risk, is accidental or unintentional events such as a car accident or an illness. And pure risks are insurable because their probabilities can be calculated precisely enough for the risk to be quantified, which means it can be priced, bought, and sold. Risk shifting involves selling your risk to others who can diversify it in a larger market and lowering the cost. You can buy insurance for various aspects of life like property, health, employment, and life. Deciding what to insure is about weighing the cost of potential losses against the cost of insurance. You can also reduce insurance costs by taking risk avoidance or reduction measures like installing an alarm system. Risk management involves deciding how much to spend on reducing, assuming, or shifting risk. It's all about finding the right balance between protection and cost. Now let's get into the insuring your property. So property insurance like home and car insurance protects your ownership rights and cover various risks. It typically includes loss due to damage, theft, loss of value, and liability for damage to others or their property. For example, it covers the cost of replacing your damaged laptop or liability if your dog injures someone. Loss or damage to property can result from hazards like fire or vandalism. The insurance shares the cost of these risks with you. Liability is about the risk of your property causing harm to others, and ownership implies responsibility for its use. You can be legally responsible for harm due to negligence, intentional actions, or even someone else's uses of your property or activities you're responsible for. So the property insurance protects your ownership rights, covering the cost of damage, loss, and liability associated with your property and possessions, offering financial security and peace of mind.
Good day everyone, my name is Alea Maydi Cabanas and I am tasked to discuss about the home insurance coverage, the benefit, and the home insurance coverage, the cost. Home insurance policies automatically cover your possessions for up to 40% of the house insured value. You can buy more coverage if you think that they are worth more. Now, the benefits are specified as either actual cash value or replacement cost. Actual cash value tries to estimate the actual market value of the item at the time of loss, so it accounts for the original cost less any depreciation that has occurred. Replacement cost, on the other hand, is the cost of replacing the item. For most items, the actual cash value is less. The actual cash value is almost always less than the replacement value because prices generally rise over time and because items generally depreciate rather than appreciate in value. Next is the home insurance coverage, the cost. Now, when you buy home insurance by paying a premium to an insurance company, the insurance purchase is arranged through a broker who may represent more than one insurance company. Now, the broker should be knowledgeable about various policies, coverage, and premiums offered by different insurers. The amount of premium is determined by insurer risk. The more risk, the more higher the premiums. Risk is determined by the insured, the person buying the policy. Next is the property insured. And lastly is the amount of coverage. And finally, to gauge the risk of the insured, the insurer needs information about personal circumstances and history, the nature of the property, and the amount of coverage desired for protection.
Hello everyone, I am Magda Gabriel F. Vanilio and I am going to discuss to you about auto insurance coverage and auto insurance cost. Auto insurance policies provide coverage for two main types of consequences. These are the bodily injury and property damage. Each type of coverage addresses different financial losses associated with different scenarios. Bodily injury liability refers to the financial losses of people in the other car that are injured in an accident you cause, including their medical expenses, loss of income, and your legal fees. Injuries to people in your car or to yourself are covered by medical payments coverage. Uninsured motorist protection covers your injuries if the accident is caused by someone with insufficient insurance or by an unidentified driver. Essentially, bodily injury liability focuses on compensating others for injury you cause, while medical payments and uninsured motorist protection provide coverage for injuries within your own vehicle, ensuring comprehensive financial protection in various accident scenarios. This coverage collectively aims to mitigate the financial impact of bodily injuries in auto accidents. Property damage liability covers the costs to other people's property from damage that you cause, while collision covers the costs of damage to your own property. To reduce the risk, the lenders financing your car loan will require that you carry adequate collision coverage. Comprehensive physical damage covers your losses from anything other than a collision, such as theft, weather damage, act of nature, or hitting an animal. Property damage liability is a component of auto insurance that covers the financial responsibility an uninsured driver may have for damaging someone else's property in the event of a car accident. This type of coverage is designed to pay for the repair or replacement costs of the other party's vehicle or any other property that may be damaged as a result of the insured driver's actions. As with any insurance, the cost of having an insurer assume risk is related to the cost of that risk. The cost of auto insurance is related to three factors that create risk: the car, the driver, and the driving environment, the region or rating territory. The model, style, and age of the car determine how costly it may be to repair or replace, and therefore the potential cost of damage or collision. The higher that cost is, the higher the cost of insuring the car. For example, a 2009 luxury car will cost more to insure than a 2002 sedan. Also, different models have different safety features that may lower the potential cost of injury to passengers, and those features may lower the cost of insurance. Different models may come with different security devices or be more or less attractive to thieves, affecting the risk of theft. The driver is an obvious source of risk as the operator of the car. Insurers use various demographic factors such as age, education level, marital status, gender, and driving habits to determine which kind of drivers present more risk. Not surprisingly, young drivers ages 16 to 24 of both sexes and elderly drivers over 70 are the riskiest. Twice as many males as females die in auto accidents, but more females suffer injuries. Nationally, in any year, your chances of being injured in a car accident are about 1 in 1,000. Therefore, auto insurance cost is determined by various factors, including the make, model, age, and style of the car. Newer or more expensive vehicles often result in higher premiums due to increased repair or replacement costs. Individual driver characteristics such as age, driving history, and experience also influence insurance costs, with younger or higher risk drivers facing higher premiums. The geographic location where the insured driver resides impact costs, considering factors like traffic density and crime rate.
Good day everyone, so today let's talk about ensuring your health. Learning objective: define basic health care coverage and major medical insurance. 2. Identify the insured's responsibility for costs. 3. Describe the structure of health maintenance organizations. Next, distinguish the different accounts for private health care financing. 5. Distinguish the different programs for public health care financing. Next, last, explain the purpose of long-term care insurance. So, what is health insurance and why do you need it? Health insurance is an agreement in which an insurance company agrees to pay for some or all your medical expenses in exchange for a monthly premium payment. If you're young, healthy, and lucky, the monthly premium may exceed the cost of your insurance. If you or some in your family have a recurring condition that needs treatment or develop one, or are injured in an accident or develop a disease, you may well incur medical bills that you cannot possibly pay. So, who needs health insurance? The simple answer is everyone. Health insurance offsets the cost of minor medical issues and major ones, including surgeries and treatment for life-threatening ailments and debilitating conditions. According to the National Coalition on Healthcare, since 1999, employment-based health insurance premiums have increased 120% compared to cumulative inflation of 44% and cumulative wage growth of 29% during the same period. If you are employed, you probably have health insurance that is subsidized by your employer. If you are self-employed, you can get insurance directly from a private insurer. If your income is low, you can get a subsidy for the cost. If you are elderly or disabled, you can get coverage through the federal Medicare or Medicaid programs. Health insurance coverage. There are many different kinds of coverage and plans for health insurance. You may have group health insurance offered as an employee benefits or as a member of a professional association. Group plans have lower costs because the group has some bargaining power with the insurer and can generally secure lower rates for its members. But group plans are not necessarily comprehensive, so you may want to supplement the group coverage with an individual health insurance policy available to individuals and families. Sufficient coverage should include basic insurance and major medical insurance. A basic insurance policy will cover physician expense, surgical expense, and hospital expense. Physician expenses include non-surgical treatments and lab tests. Surgical expenses include surgeon's fees. Hospital expenses include room and board and other hospital charges. In addition, health insurance is completed by major medical insurance, which covers the cost of the serious injury or illness, depending on the extent and the nature of your illness or injury. Medical bills can quickly exceed your basic coverage limits, so major medical can act as an extension to those limits, saving you from potential financial distress. Dental insurance also supplements your basic insurance, usually providing reimbursement for preventative treatment and some partial payment of dental services such as filing, root canals, crowns, extractions, bridge work, and dentures. Vision insurance provide your eye care, including exam and treatment for eye diseases, as well as for corrective lenses. Depending your basic coverage limits, dental and vision care could be important for you. So another feature of basic coverage is a prescription drug plan. Prescriptions may be covered entirely or with a copay, or only if the generic version of the drug is available. Your insurer should be provide a formulary or a list of drugs that are covered. Depending on your plan, this prescription coverage may be available only as a supplement to your basic coverage.
Hello everyone, I am Mary J. Panuwayan to discuss about my topic which is health insurance cost. As a healthcare cost and insurance premiums rise, insurers add cost offsets to make their policies more affordable. Those offsets may include the following. Those offsets may include the following of health insurance cost. First is deductible, an amount payable by the insured before any expenses are assumed by the insurer. Second, co-pays, partial payment for certain costs, for example, for physician's visit or prescriptions. Third is coinsurance. shared payments of expenses by insured and insurer. Each of these payment features represents responsibilities of the insured, that is, your out-of-pocket cost. The more costs you shoulder, the less risk to the insurer, and so the less you pay for the insurance policy. Making you responsible for initial costs also discourages you from seeking healthcare more than is necessary or from submitting frivolous healthcare claims. So, what is the health insurance and healthcare? Health insurance is sold through private insurers, non-profit service plans, and managed care organizations. Private insurers sell most of their plans to employers as a group plans. Individuals are far more likely to purchase insurance through a service plan or managed care. Next is managed care organizations. Became popular in the last 30 years or so with the idea that providing preventative care would lower health care costs. Managed care takes the following forms. Those are the health maintenance organizations, second, preferred provider organizations, third, exclusive provider organizations, and fourth point of service plans, and lastly is traditional indemnity plans. Next, let us know what is health maintenance organization. Directly hires physicians to provide preventative, basic, and supplemental care. Preventative care should include routine exams and screening tests and immunizations. Basic care should include inpatients and outpatients. Treatments, emergency care, maternity care, and mental health and substance abuse services. As with any plan, the details or what defines basic care will vary, and you should check the fine print to make sure that services are provided. For example, the plan may cover inpatients' hospitalizations for limited number of days in case of a physical illness, but inpatient hospitalization for a more limited number of days for mental illness. Next is the preferred provider organizations has a different arrangement with affiliated physicians. It negotiates discounted rates directly with healthcare providers in exchange for making them the preferred providers for members seeking care. Care by physicians outside the network may be covered but with more limitations or higher copays and deductibles in exchange for offering the flexibility of more choices of provider. The PPO or the preferred provider organizations charges a higher premium. Services covered are similar to those covered by an HMO. Next is point of service, POS, and also used a network of constructed preferred providers. As in an HMO, you choose a primary care physicians who then controls referrals to specialists or care beyond preventative and basic care. As in the PPO, out of network services may be used, but their coverage is more limited, and you pay higher out-of-pocket expenses for copays and deductibles.
Good day everyone, I am Erica D. Puntihon. So today I am going to discuss private and public healthcare financing. So private healthcare financing in the United States, if someone is not self-insured or uninsured, health insurance coverage is paid for at least in part by the employer. As healthcare costs have risen, employers in all industries have increasingly complained that this cost makes them less competitive in global markets. So, private healthcare financing refers to the funding and payment mechanism used to cover the cost of healthcare services in the private sector. So, it involves individuals or employers directly paying for healthcare services or purchasing private health insurance plans. Private healthcare financing offers a wider range of options and faster access to medical services, but it typically comes with costs that individuals or employers need to bear. So, private healthcare financing can involve various components such as flexible savings account. A flexible savings account, also known as a flexible spending account or FSA, is a type of financial account that allows individuals to set aside pre-tax money to pay for eligible medical expenses. It is typically offered through employers as part of their employee benefits package. The funds contributed to an FSA can be used to cover cover various healthcare costs such as doctor visits, prescription, medications, and medical supplies. Any unused funds in the account at the end of the plan year may be forfeited. So it is important carefully estimate and plan for eligible expenses. Second is health reimbursement account. A health reimbursement account or HRA is an employer-funded benefit plan that helps employees pay for qualified medical expenses. It is designed to supplement an employer's group health insurance plan or to be used in conjunction with a high deductible health plan or HDHP. Employers contribute a set amount of money to the HRA and employees can use these funds to cover out of pocket healthcare costs. So knowing about HRAs is important because they provide employees with additional financial support for their healthcare expenses. It can help offset the cost of deductibles, co-payments, and other medical expenses not covered by insurance. HRAs can be used for a wide range of eligible expenses including doctor visit, prescription, medication, hospital stays, and medical procedures. HRAs offer flexibility as employers can customize the plan to meet the specific needs of their employees. The funds contributed to an HRA are typically tax-free for employees, providing additional savings by understanding how HRAs work and the benefits they offer. Employees can make informed decisions about their healthcare and effectively utilize the funds available to them. And the last is health savings account. A health savings account or HSA is a tax advantage savings account that individuals can use to save money for qualified medical expenses. It is available to individuals who have a high deductible health plan or HDHP. Contributions to an HSA are tax deductible and the funds in the account can be used to pay for various healthcare expenses, including doctor visits, prescription medications, and medical procedures. One of the key benefits of an HSA is that the contributions, earnings, and withdrawals for qualified medical expenses are all tax-free. The funds in an HSA can roll over from year to year, allowing individuals to accumulate savings for future healthcare needs. Additionally, HSA are portable, so meaning they can be taken with you even if you change job or health insurance plans. Having an HSA is important because it provides individuals with a way to save and pay for healthcare expenses while enjoying the tax advantages. It can help individuals manage their healthcare costs, especially if they anticipate higher medical expenses or want to save for future healthcare needs. So, private healthcare financing allows individuals to have more control over their healthcare choices and access to a wider range of healthcare providers. It can provide faster access to medical services, shorter waiting times, and more personalized care. However, it is important to consider the costs associated with private healthcare financing, as it can be more expensive than public healthcare options. So, knowing about private healthcare financing is important because it allows individuals to have more control and options when it comes to their healthcare. Understanding private financing options helps individuals make informed decisions about their coverage, costs, and access to medical services. It also enables individuals to plan and budget for their healthcare expenses effectively.
Good morning everyone, my name is Karen Robledo and I am going to discuss the long-term care insurance, long-term care coverage, and ensuring your income. So long-term care insurance is a type of insurance policy that helps cover the costs associated with long-term care services. These services are typically needed when an individual is unable to perform basic activities of daily living. So care refers not to medical care but to care of activities of daily living or the ADLs. So such as bathing, dressing, toileting, eating, and mobility, so which may be impaired due to physical or mental illness or injury. while long-term care coverage is offered as either indemnity coverage or expense incurred policies. So when we say indemnity, it means security or protection against a loss or other financial burden. So with an indemnity policy, you will be paid a specified benefit amount per day regardless of your costs incurred. And with an expense incurred policy, you will be reimbursed for your actual expenses incurred. So both types of policies can have limits either for dollar amounts per day, week, or month, or for number of days or years of coverage. So long-term care insurance can help you prepare for the potential costs of extended care in the future and protect your assets. As discussed in the previous topic, assets such as a home or car should be protected from the risk of a loss of value because assets store wealth, so a loss of value is a loss of wealth. So in addition, you have an accident or illness that leaves you permanently impaired or even dead. In either case, your ability to earn income will be restricted or gone. Thus, your income should be insured, especially if you have dependents who would bear the consequences of losing your income. Disability insurance and life insurance are ways of insuring your income against some limitations, and that will be discussed by the next reporters.
Good day everyone, I'm Alisa Tumala and I'm the reporter of the topic Disability Insurance. So, disability insurance is designed to insure your income should you survive an injury or illness impaired. And also, disability insurance is a safety net for your income, offering financial protection if you're unable to work due to an illness or injury. The definition of disability can vary across policies, influencing when and if you're eligible for benefits. Definition variability. Some policies pay if you can't do your regular work, others pay only if you can't do any job. Some might give partial benefits if you can work part-time. Cost factors. Several features determine the premium of your disability insurance. First, the waiting period. The time you must wait after becoming disabled before you start receiving benefits. Typically, this ranges from 30 to 180 days. A longer waiting period can reduce your premium. Second, amount of benefits. Usually a percentage of your current salary, more benefit mean a higher premium. Third, duration of benefits. How long you'll receive the payments, longer duration raise the premium. Fourth, cause of disability. Cover specific causes like accidents or illnesses. Fifth, specific losses. Some policies pay for specific losses like loss of vision or hearing. 6. Inflation-adjusted benefits. Benefits that increase with inflation. Lastly, guaranteed renewal or non-cancelable clause. Ensures your policy won't be cancelled if your health worsens. Existing coverage. Many people might already have some form of disability coverage. Some are from employer provided. Many employer provides disability benefits, but they might not be extensive. Social Security and workers' compensation. If your disability is due to work-related accidents, you might be eligible for benefits from these government sources. And there are other providers, the Veterans Administrations, that is for veterans, automobile insurance, if disability results from a car accident, labor unions is for members, civil service provision is for government employees. Recommendation: always understand the extent of your current coverage. If it's insufficient, consider supplementing with private disability insurance to ensure comprehensive protection. In essence, disability insurance acts as a financial buffer, safeguarding your earnings if you're unable to work due to disability. Different policies offer varied terms, so it's crucial to understand and choose the best suited to your needs. So the next topic is life insurance. Life insurance is a way of ensuring that your income will continue after your death. Life insurance also provides financial support to your loved ones after your death. It's a means of ensuring that if something happens to you, those who depend on your income or care won't face financial hardships. Purpose of life insurance. Before getting a policy, consider what you want it to achieve for your survivors. Some common reasons include: first, mortgage payment. To clear outstanding home loans so your family can remain in their home without financial strain. Second, educational funds. Ensure your children can attend college or get higher education. Third, replacement of income, offering your spouse or dependents a steady income source so they don't have to suddenly join the workforce. Fourth, elderly or dependent care, covering costs for the care of elderly family members or dependent siblings. Fifth, final expenses, covering medical bills and funeral expenses. And lastly, estate considerations, minimize estate taxes after your death. Determining needs and costs. The purpose and goals for the life insurance will influence the policy size and type. Equally important and how the policy premium fits within your budget. In summary, life insurance isn't just about the primary earner. It's about the understanding the value and costs associated with all roles within a family unit. By evaluating each person's contribution and the financial implication of their loss, families can make informed decisions about the type and amount of life insurance they need. It ensures that survivors can maintain their quality of life even in the face of unexpected tragedies. And that will be all for my report. Thank you so much for listening.
Hello everyone, my name is Alea Medi Cabanas and I'm also tasked to discuss about the choosing policy and life insurance as financial planning decision. All life insurance policies have basic features which then can be customized with a rider, a clause to a policy that adds specific benefits under specific conditions, a clause that adds benefit under certain conditions. Now, the standard features include provisions that protect the insured and beneficiaries in cases of missed premium payments, fraud, or suicide. There are also loan provisions granted so that you can borrow against the cash value of a whole life policy. Riders are actually extra insurance that you can purchase to cover less common circumstances. Commonly offered riders include a waiver of premium payment if the insured becomes completely disabled, a double benefit for accidental death, guaranteed insurability allowing you to increase your benefit without proof of good health, cost of living protection that protects you from benefit from inflation, and lastly, accelerated benefits that allow you to spend your benefit before your death if you need to finance long-term care. Finally, you need to consider the settlement options offered by the policy, the way that the benefit is paid out to your beneficiaries. So there are three common options. Number one, as a lump sum, paid out all at once. Second is in installments paid out over a specified period. And lastly, as interest payments, so that a series of interest payments is made to the beneficiaries until a specified time when the benefit itself is paid out. Now, choosing a various option will always depend on your beneficiaries and their anticipated needs. Understanding these features, riders, and options is very important as this can help you to identify the appropriate insurance product for your situation. As with any purchase, once you have identified the product, you need to identify the market and financing. Next, life insurance as a financial planning decision. Life insurance can be an important financial planning tool for people at all stages of life and in various types of situation. The death benefit can provide a much needed infusion of cash and many policies offer other benefits as well. Hence, life insurance is designed to protect dependents against the loss of your income in the event of your death. Unlike insuring property and health, life insurance can combine two financial planning functions, shifting risk and saving to build wealth. Now, the decision to buy life insurance involves thinking about your choices for both and your opportunity cost in doing so. Thus, life insurance is about ensuring your earnings even after your death, and now you can create earnings during your lifetime by selling labor or capital, Your death precludes your selling labor or earning income from salary or wages. But if you have assets that can also earn income, they may be able to generate some or even enough income to ensure the continued comfort of your dependents even without your salary or wages.